If you've watched this channel for a while, you know that I'm a pretty big fan of CBRE's publicly available research, and over the past few weeks, CBRE released their Q1 2023 figures for each of the four major real estate product types: industrial, office, retail, and multifamily, and they also released their US capital markets and US lending figures reports, each of which included some really interesting insights into the state of the commercial real estate market and what's going on throughout the industry right now. A lot of this information wasn't surprising given all the changes we've seen in interest rates over the last year, but I found a few things in these reports that are definitely worth paying attention to if you're an investor or trying to land a job in this industry. So in this video, I want to share my three biggest takeaways from these reports, why these things might be happening in the market today, and what this all might mean for you as an investor or industry professional heading into the second half of the year. So the first thing worth noting in these reports comes from the Q1 2023 US capital markets figures report, and this is that most major capital sources in commercial real estate are sitting on the sidelines almost entirely right now, which has led to transaction volume plummeting to levels we haven't seen since the spring of 2020 and the early 2010s. Commercial real estate investment volume in the US dropped by 57% year over year in the first quarter of 2023, down to just $78 billion, which, to put this into perspective, was less than half the 5-year average transaction volume between 2015 and 2019, before we saw so much market volatility in 2020, 2021, and 2022. And these numbers could be even more alarming than they look at first glance, because many asset classes have seen substantial NOI growth since 2019, and cap rates in many markets are still below their 2015 to 2019 levels, especially in product types like multifamily and industrial. So just by looking at transaction volume in a whole dollar format alone, this could be hiding a significantly smaller number of individual transactions that are actually getting done in the market right now. And this is right in line with what we're seeing in the performance of the companies that rely most heavily on commercial real estate transactions to generate revenue, with 5 of the 6 largest brokerage firms in the industry posting losses in the first quarter of 2023, and many voicing concerns during earnings calls that these drops in revenue might continue for longer than they'd expected. Between Colliers, Cushman & Wakefield, JLL, Newmark, and Marcus & Millichap, these companies lost a combined $121 million in the first quarter alone, with CBRE being the only firm on this list to generate a net income for the quarter, but at a 68% drop from their Q1 2022 figures. In the first 3 months of this year, investment volume from private investors dropped by 58% year over year, investment volume from institutions dropped by 65% year over year, and investment volume from REITs dropped by 82% on a year over year basis, with the only buyer type to see an increase in volume being cross-border investors that in 2022 only made up less than 4% of the market. Now, this is a lot of bad news, but the good news is that even though this has caused companies to pull back on hiring and even lay off some of their workforce, with estimates of over $240 billion of dry powder in private equity real estate funds at the end of 2022, as soon as the Fed makes a pivot and actually starts to cut interest rates again, there's very likely going to be a flood of capital that's ready to enter the market. So if rates do come back down later this year or in early 2024, we might be in for a really quick recovery, at least from a transaction activity perspective, which should result in a huge uptick in hiring at brokerage, investment, and development firms. Now, the next thing I found interesting in this research comes from the same US capital markets figures report, but this time on the lending side of the equation. And this is that with a combination of transaction activity drying up almost completely and interest rates absolutely skyrocketing last year, lenders were arguably hit even harder than many investment and brokerage firms in the first quarter of 2023. In Q1, year-over-year loan origination volume dropped by over 61% across all lenders tracked by CBRE, due in large part to the huge rate increases we saw throughout the last 3 quarters of 2022, significantly disincentivizing borrowers to acquire properties in the first place and to refinance the properties that they own unless absolutely necessary due to a loan maturity. Over 85% of loans of more than $10 million originated in the first quarter of the year had interest rates above 5%, and over 60% of loans less than $10 million had interest rates above 5.5% during this time. And when we compare these to the rates that we were seeing in 2020 and 2021 at some points in the high 2s or very low 3s, it's really clear as to why this activity is falling off. Now, this wasn't all that surprising given the recent run-up in rates, but what was interesting to see is that debt service coverage ratio requirements have actually dropped pretty substantially over the past 3 years, down from an average of 1.51x in the first quarter of 2020 to just 1.36x in the first quarter of 2023. And while fewer loans are being made, lenders are also making significantly more loans with partial or full-term interest-only periods to ease the pressure of those rising rates and make deals pencil at this new pricing. What was also really interesting to see was that mortgage delinquency rates, defined as loans that were either 30 or 60 days delinquent or more, were actually lower in Q4 of 2022 than in Q4 of 2021 for CMBS lenders, bank lenders across all asset types, and even Fannie Mae lenders, and delinquency rates only increased by 7 basis points for life insurance companies and by 5 basis points for Freddie Mac lenders, which both had the lowest total delinquency figures among all lenders on this list. This is all really telling me that while significant distress in the market doesn't appear to have started just yet, if rates stay at current levels for the next 12 to 24 months or longer, we'll very likely start to see more delinquencies start to materialize as loans made in 2020 and 2021 start to mature. And for investors looking for heavily discounted assets, this will likely be the sweet spot from a timing perspective to take advantage of these shifts and find undervalued deals. And then finally, one of the most interesting and potentially counterintuitive trends that I took away from these reports came from the Q1 product type specific figures, and this is that right now, out of all 4 major asset classes within commercial real estate, retail may be the strongest from a fundamentals perspective. Multifamily and industrial, 2 of the hottest asset classes over the last several years, have recently started to see some really concerning headwinds in relation to supply. Net absorption for industrial properties across the US fell significantly below the 10-year average in the first quarter of the year, leading to vacancy rates actually increasing by 50 basis points over 2022 figures. And for multifamily properties, this sector saw their 4th consecutive quarter of negative net absorption, with Q1 vacancy rates increasing by almost 100 basis points from the first quarter of last year. And with office performing pretty much exactly as expected, with very poor leasing demand exceeding typical seasonality shifts and the difference between asking rents and taking rents continuing to widen, retail was the only product type tracked to see leasing trends actually moving in the right direction, with its 10th straight quarter of positive net absorption, retail availability dropping to just 4.8%, its lowest figure on record, and new space deliveries also coming in at record low numbers in Q1, with new space deliveries coming in at just 5.1 million square feet in total. Now, obviously, future retail property performance is going to be heavily dependent on the economy, so if economic conditions start to soften throughout the rest of this year and into 2024, there will be some additional headwinds that investors in this part of the industry will have to overcome. But with the supply and demand imbalances we're starting to see in other property types across commercial real estate, retail might be one of the best places to be, at least in the short term. Ultimately, Ultimately, if you're looking to break into the real estate industry or trying to take the next step in your career this year, even though the job market is tight right now, if rate cuts do start to happen later this year or in early 2024, we could see a pretty sharp reversion back to at least 2019 activity levels, which should lead to job opportunities opening back up. But if you're looking for opportunities right now and you want to go where the fundamentals are strong, you may want to consider other avenues outside of industrial and multifamily focused roles. And contrary to popular belief, retail could be a very viable option to get your foot in the door. And if you are trying to break into the industry this year and you want to make sure you have the technical skills you'll need to make that happen, then pass an Excel modeling exam if one is given to you during the interview process. As always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on the state of the commercial real estate market, make sure to hit the like button to let me know. And if you're an investor or you're working in the industry right now, let me know in the comments what you're seeing today and where you think the market is headed throughout the rest of the year. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.